everybody. Welcome to another edition of the 1Mby1M podcast. Today, I am speaking with Deb Kemper from Golden Seeds, and I am looking forward to learning about Golden Seeds as you are. So, Deb, welcome. Let's start by introducing our audience to yourself as well as to the investment thesis and focus of Golden Seeds.
Sure. Nice to be here. Thanks for having me on. I am what's called an angel investor, and that is what Golden Seeds is. Golden Seeds is a hybrid angel network and small micro VC fund. The angel network has around 300 members across the United States, and we primarily invest in companies that have a woman founder or woman on the founding team. So we like to call it gender diversity. It doesn't have to be a majority female-owned company, but it has to have a woman in the C-suite with at least 10% equity is our cutoff criteria on our funding. And the reason we do that is this is a group of people that have been historically underfunded in the VC markets and the angel funding markets, receiving less than anywhere from 3 to 5% of venture capital, and less than 20% historically of angel capital. And so we're just trying to get to parity in that, and we feel there's positive and above market returns in trying to do that.
Mm-hmm. And what check sizes do you like to write?
So, our check sizes vary whether or not, we've led a deal or not, but I'd say on average, we're looking for companies that are looking to raise between $500,000 and several $1 million on their seed round. And, on the upper side of that, we would normally be syndicating with other angel groups or smaller micro VCs.
And how big is the micro VC portion of your activity?
So Golden Seeds has a fund that has about $30 million under management.
Okay.
So, which is, again, that's why we call it micro VC. That these days that seems like a smaller VC fund when they're raising upwards of $1 billion these days.
Yeah. Well, this is part of the the shift that's happening in the early stage, seed stage venture capital ecosystem. There are now 700 plus micro VCs in the market. So it's that part of the ecosystem has a lot of liquidity, but it's become very complicated to understand who wants to invest in what stage of validation, right? There's pre-seed, there's, seed. Now, how do you define seed? What stage of validation qualifies as a seed? Everything is moving upstream in terms of how much validation is required to raise money these days.
That's very true, and it's one reason why we like having the affiliated fund is because it helps bring some of that later, a longer, what's the right way to say this, the follow-on capital, because it's taking longer. There's more micro VCs, but you still need to have the runway to get to what used to be a Series B is now what we call a Series A.
Absolutely, and not even that. It could be a pre-Series A before Series A as well. So yes, it's very, very complicated. So you could be in a situation where your angel group funds a pre-seed or a seed, and then he comes in with the post-seed or pre-Series A. Is that a reasonable observation?
Yes, that could happen, or sometimes they might come in at the same time. But I'd say normally the angels like to go in a bit earlier than traditional funds might want to do. Okay.
And so let's talk about that. What is the level of validation that your angels are looking for? Are we talking pre-seed? Are we talking seed? What kinds of metrics are you looking for in the angel part of the equation?
So I always say it varies. I think we have some investors who really like to go in early, like to be first money in. They might be willing to go in before you have customers, and you might be working to develop your minimum viable product. And we have others who, I think there's more angels who want to come in once you have a clear first customer market fit, right, or product market fit and customer base you're going after. So again, with a wide variety of angels in our network, you have a variety. It's a bell curve, right? There's some who like to go early, and there's some who are a little more, risk averse. Even though these are risky investments, I say there's some who take more risk tolerance in the sector, and some who prefer a little less risk tolerance.
And what is the earliest they would go in? Is it a pre-seed? Would people go in with no product, just a concept, or people want to see validated product market fit before they would go in?
No, people will go in before validated product market fit. I'd say it's between a concept and having that. So usually something built that, at least a beta is what we would say. We rarely go in on an alpha stage of, it's just a concept on a napkin is what I like to refer to it as, and we're going to go build it out. We generally like to see that people have figured out a way to do that initial build out, and we'd come in at the beta where there's probably some clear testing you're trying to do, some milestones you're trying to hit, and could then, there's the clear stage gating of what's going to happen and things that'll be learned from that, with whatever money we're putting in, whether it's $500,000 or it's $1.5 million raise. What I was going to say about Golden Seeds, just a quick thing, is it's also very different. We are what we call sector agnostic. Since we focus on the gender diversity question, we try not to limit too much on the technologies and sectors that we look at. So a big difference in this might be we see some life sciences companies that would be very far from revenue. And so it's not that you have to have all revenue. That's why it's always hard to give a very definitive answer, like some that have a very narrow thesis.
For this conversation, let's limit the discussion to technology and technology-enabled services only, and that's information technology. We don't do biotech, we don't do pharma, we don't do life sciences. So you can answer all my questions with just the IT and IT-enabled services hat on.
Perfect.
So, all right. So now, you sector agnostic, yes, but let's talk about within IT. Are you doing both B2B and B2C? Are both of those okay?
We prefer, the majority of our investments are B2B. If we do B2C, it's what I would call B2B2C. So where maybe you're going, your ultimate end user is an individual, but you might be, the channel to them is through businesses.
Businesses, okay.
Right, maybe companies.
And what about, go ahead.
I would say, where you're selling into like employee benefit programs or some things we're seeing, or you're going in through in some of the other applications we see, you're going in through someone who's then going to rebroadcast out your application to get to that ultimate end user.
And what about geography?
Golden Seeds invest nationally. So we only invest in U.S.-based companies, but we do invest nationally. We have hubs in 6 cities, so Boston, New York, Atlanta, Houston, Dallas, and Silicon Valley, which isn't a city, it's a region, but that's how we define it. So we have hubs there, but we will look at deals from across the U.S., and we normally funnel those into whatever group is closest. Because there is there is a bit of a regional bent to angel investing.
Yeah. So let's talk about a few of your portfolio companies. Just pick ones from the IT-enabled services sectors. What are some of the highlights of your portfolio? And especially as you're talking through them, if you could give us a flavor of how, what was the thinking behind choosing to invest in those companies? And then how does the angel group and the micro VC play into a deal?
Sure. Okay, so in the IT-enabled services, so a company in our portfolio is called GroupEyes. This is a company that's been around for around 4 or 5 years. Golden Seeds was the deal lead on that, which means we wrote the term sheet and have been working closely. We have someone who's on the board. I am not on the board of this particular company, but they basically are a service, a SaaS platform that is helping travel planners book small meetings. So these are meetings of less than 20 people where normally you don't have a formal event planner, but there's some technology integration to make this happen smoothly for people. And what makes this attractive is it was founders who knew the market. They came out of the travel industry. They had started building the technology that was needed. Were able to get a team around them to do that technology build out. And what's kept it going over time is that they've really started building their reputation in the market, and we're seeing large industry players starting to stand up and take notice. And so they're growing their revenue. I mean, they're still private. I have to be careful what I say, but it's a good. It's been great to watch how they've had to do some pivots and tailor their product over time, but still are really, the market's catching up to the vision that they had. So that's one example. Another example is a company called Constant Therapy, which is in actually the healthcare space, but it's an app that actually was to consumers. It was for stroke patients to help them do therapy at home and continue their speech therapy at home. And again, true domain expertise in the founding team. One of the founders is an expert in this area out of Boston University, and founded this company. And it was actually it's my portfolio is still young, but it's one of the exits I had. They were acquired within 18 months of our investment by a bigger player, Digital Health Corp, that wanted to bring this technology in-house. And so it's trying, I think if there's a thread between both of those, it's people who really see a need in the market and are building the technology for folks to then say, okay, they're growing, they've got a real customer base, we can acquire them and bring them in.
And what stage did you get involved in either of these companies? What did they have when they came to you?
So for both of them, Golden Seed was in their initial seed financing round. On one, I was in the seed. On another, I got in a little bit later. I didn't invest the first time it came around. I kind of missed some of the initial up round, but I got in later on.
And did your micro VC also invest in these companies?
It did in one of them, but
okay.
Yeah, it did in one of them.
So I'm listening to you about the second company where you've already got an exit within 18 months, which is a good segue into a question that I want to ask you. There are 700 plus micro VCs and tons of angel groups, and I talk to a lot of them, and I very often hear that these are people who are all looking for unicorns, $1 billion market cap, eventually $1 billion market cap companies. And I'm thinking, well, that's not mathematically possible. Unicorns are rare animals, so we can't really have unicorns a dime a dozen. So, however, we are in 2018. There are tons of companies out there, tons of niches out there, and there are lots of companies that are pursuing some of these niches. So you can actually build very good businesses that are, catering to some of these niches. Maybe they don't have these billion-dollar, multi-billion-dollar TAM. They're operating on $200 million, $300 million TAMs and building, good products that fit into those niches and have product market fit and so forth. So you can do capital efficient business building in these niches. And then you can potentially seek early exits. The truth is, most of the exits in the industry happen under $50 million at an under $50 million valuation range. So what is your thought on all this? How do you process all this? I mean, this unicorn mania versus...
I am not a unicorn hunter. I'll be very honest. I follow a very similar philosophy to what you laid out in terms of most of these companies exit via M&A, merger and acquisition, between $30 and $50 million. And you can have a whole bunch of those, and they're fairly capital efficient and have a very good return on investment. So my investment thesis is you can do great with a bunch of doubles and triples, and companies where you're getting your return faster versus trying to go unicorn hunting. The issue with unicorns is that they require a lot of capital, and as an angel investor or a very small fund, you don't have enough capital to stay in the game and not be crammed out or wiped out off the cap table. But if you have a company that's only going to need maybe 5 to 10 million to get to an exit, it's a much safer place, not quite the right word, but it's to be playing in, versus companies that you see are going to need, unicorns take 500, 50, 100, 250 plus $1 million to get to market. We can't play with that coming in with initial check sizes of the 250 to 500K range, right?
Yeah.
As angels,
well,
you just can't continue to play.
These large investors load the cap tables up with the liquidation preferences and squeeze down all the early investors and so on and so forth. There are lots of dangers of unicorn hunting for small funds and angels, I think.
And I think there's a couple other things about unicorns versus not, right? Which is there are a lot of really good business ideas out there. And companies are looking, if you think about the M&A markets, right? Your bigger companies, your corporates, right, are looking, what a lot of people will view as competition when people are building these companies, are actually looking to acquire growth. And so if you have an idea that you're then, you're showing that you're getting significant year-on-year revenue growth, and you start getting into the 10 million plus revenue range, you're attractive for someone to acquire and then use them to help you scale, versus at least what I see when I talk to corporate venture folks is they don't want to go and rebuild this. It's cheaper and easier for them to acquire the talent and the customer base versus trying to rebuild. Whereas I think on the unicorn hunters, they're trying to be extremely disruptive. They do some amazing things, and hopefully I'll have something that's that big. But if I limit myself to only trying to find those, I could have none.
Yeah, absolutely. I'm completely in agreement with you, and I really think that there should be a large pool of investors who are not unicorn hunters, but who operate within the equity investing framework that we use in our ecosystem, and can, may have successful investments, the doubles and triples, as you called them. And we need more of those. And it's kind of unfortunate to see this mania, unicorn hunting mania, and it actually makes me feel like we're just going to see a lot of failures unnecessarily, where some of this money could have been channeled better.
Mm-hmm. Well, I think it's also a function of fund economics, right? Which is, if you have a $30 million fund, you get a $60 million exit, you've paid back your fund, right?
Yeah.
Plus. Whereas if I have a $1 billion fund, right, I need a $1 billion exit plus, right, to return my fund.
That's a different business. I think $1 billion fund, that's growth equity, that's almost private equity. That's not really venture capital, because you can't really, if you have $1 billion fund, you have to write very large checks. And that almost, if you force entrepreneurs to take that level of capital, you're just setting the exit bar so high, and there are fewer acquirers, and then you have to go public. Not everybody can go public, blah, blah, blah. Gets into very unhealthy dynamics often.
Yeah. I think there's another piece of it too, though, which is some conversations I've been having with entrepreneurs recently, which is there's something about running lean early and really finding product market fit and having some failures and not on a lot of cash, that where they have very creative ideas on how to do things. You don't want to starve, right, a company, but there is something to having the right amount of cash at the right time, versus, hey, we're just going to go build something out, go big or go home, and then you end up with nothing. Right? It's just,
you don't
no
believe at all in go big and go home. I think it's complete bullshit.
Sorry, I didn't hear. I missed your first part of that. Go big or go home.
I said we don't believe at all in go big and go home. I think it's complete bullshit.
Right. I sort of prefer the do it, try it, fix it approach is one phrase I use. Do something, try it, and then fix it, and also go slow to go fast, which is, do some foundational work that's needed to then really be able to just, use that as a platform to scale quickly. But I think if you try and scale too quickly, a lot of times it's on an unstable foundation.
Yeah. So slightly different line of questioning, since you are working all with the female founders, what is your take on the ecosystem? Do you believe there is a bias against women in the women in entrepreneurs in the ecosystem?
So I do, but I don't think it's conscious, right? I think it's unconscious, and that's what makes it so difficult to try and change. There's a lot of research that's been coming out recently. Folks like Donna Kahns from Columbia, Lakshmi Balachandra from Babson, that have been doing a lot of really amazing research on this and showing the biases we have as investors when we're talking to entrepreneurs. And what's been fascinating for me in chatting with them and learning about their research is it's not just men who have the bias, it's women too. And so as investors and as at Golden Seeds, where we're 80% female investors, we have 20% of our investor base is male, right? Trying to educate ourselves on how do we ask questions? Well, it turns out we ask women entrepreneurs questions differently than we ask male entrepreneurs. And so we're trying to educate ourselves and our male colleagues in other groups on how do we actually try and shift this, because this isn't a pipeline problem. There are enough companies out there with women in leadership positions. It's how we're getting them into the process, how we're coaching them through the process, how we're asking the questions of them in the process. And it's really fascinating research that's being done that we're trying to internalize and also broadcast out more broadly so people can understand it. And it's actually, there's an important message in there for entrepreneurs, because some of the research says that women get asked more prevention questions versus promotion questions than their male colleagues. And if you get asked, what does that mean? So promotion would be, what's your aspiration, versus prevention would be, well, when do you hit break even? They're more about risk mitigation. And when those questions get asked early on in the process, so in the early pitching stages, the companies that get asked more prevention questions get less money than those that are able to kind of really talk about their aspirations and their visions for the company. And what was fascinating from that was, in the research for me, is, okay, how do I coach entrepreneurs to take a prevention question and flip it to a promotion answer? And I think that's a key thing we have to work with entrepreneurs, right, your audience, or the folks on your platform, on how do, if you get that prevention question, do you then make sure you get back to the aspirational and the promotion and the promise of what your company can do, versus going in the rabbit hole of risk? Because all of these companies are risky, and it's all about understanding the risk and making sure you understand it and can work to help the company grow despite those risks.
So it's a great point. Can you give an example of a prevention question, and how do you turn that into a promotion answer?
I'm going to be thinking on the fly on this. I would say, so prevention question would be, when do you hit break even, right? So when does your revenue, cover your costs? And I think you could answer that and say, our target to break even is 18 months. But, I would then switch it to say, but, it's amazing, because at that point, that's just, we're at, 0.5% market penetration. If we get to 5, if we really do what our vision is, the market's Y. Like, that's a bare minimum case, right? We want to be 100x that, 1,000x that, in 24 months or 36 months, right? So you want to address the question that gets asked, but then make sure you're taking it back to your aspiration, which is, my plan isn't to break even in 18 months. My plan is to have this huge company in 3 years.
Interesting. Very interesting. And you're saying that the research shows that the women get more of these prevention questions. I hadn't heard that before. So very good insight, actually. I was
anticipating. I'm happy to send you the links on that because it is incredibly fascinating and
very interesting. Yes, fascinating.
I definitely and want to keep reading more on this and having the discussions because I think it is important to how do we change the questions. And I even myself now, since I've learned all this over the last, literally it's been over the last 3-4 weeks, is okay, how do I change my questions now when someone's pitching to me for the first time?
Yeah.
At some point, I want to understand when their break even is, but how do I make sure I'm asking the right questions in a bigger session so I'm not putting them on their back foot, right? So that they can shine their best, right? As they're trying to get people excited about the company. Because I always tell entrepreneurs, every conversation is to get you to the next conversation.
Yeah. So let me ask you something much more blatant, which is, when people look at young women entrepreneurs, often there is this question about, how does this person manage, it's cliched bias of how does this person manage children and family and being an entrepreneur and the long hours needed and so on and so forth. What your current investigation is reporting what on this topic?
They're doing it, right? I mean, no one ever asked their male peers those questions.
No,
they figure
definitely
it out,
not.
right?
But I've been asking this question because there's a lot of sensitivity around this right now. So I suspect this is a latent. This question is latent, and they don't really come out and ask it, right?
No, it is latent, and so obviously in our group, again, having 80% women, most of whom had successful careers, they figured it out. They figure the entrepreneurs will figure it out. I do have entrepreneurs who've said that they've been asked those questions. They're always a little surprised because it's not necessarily an appropriate question, or so usually they won't answer. Or they'll say, we'll figure it out, or they give some insight. But if they are confident enough, some of them will say, do you ask male entrepreneurs that? But that's how I coach them, and I say just know going in that they would never ask a male that, and so just say, I've got a plan in place. Right? No one really needs to know what their plan is, but just say you have a plan in place. I have a CEO in my portfolio who had a baby, 2 years after funding, and she's figured it out. It wasn't even an issue. We figured out we had contingency plans as a board. We thought about it because we had to have contingency plans. God forbid something happened. But, from that standpoint, but from an investor standpoint, you figure they're going to figure it out just like the guys do who have, who start a family or have a family. And I think that's a bigger discussion in society that we have to have where, it gets to that implicit or that unconscious bias of, well, it's the woman who that's on versus the man in the family.
Well, I mean, the bias comes from history, right? History and anthropology that typically women have been taking care of children and families, and men have not been taking care of children and families. So I think it's that shift of men participating more in taking care of children and so forth is a newer phenomenon, and it's not even pervasive. It's actually in certain societies still not the case.
Right. No, I was going to say you have a global community. I'm not sure if you're aware of this, but I've lived in both South America and in Asia, and it's very different in every area. And to be honest, in some areas, it's actually easier for women to stay in the workforce, right? Given some things, and in some it's harder, again, because of cultural norms. So I can imagine for your community, it would be very different depending on where they are. I mean, I speak from an investment standpoint. I speak from a very U.S.-centric, but having lived overseas, I think in some ways it was easier in some places we lived. I'm Indian originally, even though I've been in the U.S. now for a very long time. But in the Indian society, culturally there's a lot of help. Everybody, even lower middle class families have servants. So there's nannies and lots of domestic help. So that covers a piece of the puzzle. And there's also this phenomenon of extended family. There's family members actually
living, mother-in-laws, and so on and so forth. So I actually wrote an article at some point with a case study. And I think the title of the article was "Make Your Mother-in-Law Your First VC." It was an Indian entrepreneur who basically had tremendous mother-in-law support, which made it possible for her to do what she did, is dedicate huge amounts of time into building a company. So
no, that's absolutely true.
And here, I think it's only possible for those. Some of those cultures are living similar phenomenon out here, right? Their mothers-in-laws come and move in with the family here and provide a lot of that child care support and so on and so forth. It's very common in the Indian community to have a mother-in-law living for better part of the year here with the family. So that those options
really?
Actually remain even in the U.S. for certain women who are from those cultures.
Well, it's interesting. I think a key part of this for to remember is being an entrepreneur and founding a company is incredibly stressful and
yes.
puts a lot of strain on a family,
yes.
whether there's children or not. Even couples, right? And I see that across the board with male and female founders.
Male and female. Yeah.
Is the other spouse willing? Does their significant other have the same risk tolerance that they do? Are they willing? Some couples, it's like, hey, I'll have a steady job, I'll be the entrepreneur. I think it's very scary. We have some companies we see where both spouses have gone in, to the enterprise, and they're all in, right? Because they're both banking on this, and so it's all about risk tolerance. But it's very stressful, and I try and make sure with my entrepreneurs that they have an outlet of someone to talk to, and if it's someone on their board or a peer group of other entrepreneurs, right, to be able to talk about those sorts of things, because it's fun, and people who do this for because they're passionate about the mission and the company they're trying to build, but it has a lot of ups and downs along the way.
Yeah, absolutely. And the shock absorbers are very important, and how you create those shock absorbers in your life are really part of the success of an entrepreneur's journey, I think.
I love that phrase. I had not heard that phrase, shock absorbers. I love that. I'm going to steal that.
Well, it's a great conversation. We could go on, but I believe we have to let our audience go. So thank you, Deb, for your perspective. And audience, thank you for listening. So as you know, every week you can come to our roundtables and get project-based coaching, mentoring at the free public roundtables. Go to the website 1Mby1M.com and sign up there, and we will send you instructions on how to set yourselves up for the pitch. And we will back again soon with another edition of the 1M by 1M podcast. See you soon.